Hello everyone, welcome back to the channel. Today we are diving into a topic that is going to save you thousands, maybe even tens of thousands. When it comes to selling your investment property, I'm talking about capital gain tax and how you can legally reduce it or even avoid it altogether. Now, I know taxes can sound boring, but trust me, this is the kind of stuff that can make a huge difference to your bottom line. So stick around it because I'm going to share 5 smart strategies that a property investors like you use to keep more money in your pocket. Let's get into it. All right, let's start with the strategy 1, principal place of residence exemption, which we also call PPR exemption. This is a big one and here is how it works. If you live in a property as your main home, you don't have to pay capital gain tax when you sell it. It is very simple, right? But here is a trick. Even if you move out and rent it later, you can still claim a partial exemption for the time you lived there. I'll give you a very small example. Let's say you buy a house, lived it for 2 years, and then rent it out for another 3 years before selling it out. You have owned that house for 5 years in total, but because you lived it for 2 years, 2/5 of the capital gain could be exempt from CGT. The key is to keep good records like proof of when you lived there and when it was rented. This is a super simple way to save big on capital gain tax. Now let's talk about strategy number 2, the 6-year rule. This one is a game changer. If you're planning to move out of your home and rent it out in the market, here is the deal. If you move out of your main home and rent it, you can still treat it as your primary place of residence for up to 6 years. That means if you sell it within 6-year window, you won't pay any capital gain tax, even if it has been rented out within the whole time. But there is a catch. You can only claim this exemption for one property at a time. So if you buy another home and move into it, you will need to choose which property get the tax break. This is a fantastic strategy if you are planning to move out temporary basis, maybe for work, or try it out another suburb, maybe for the kids. They wanted to change the school but want to keep your options open to sell it later. Next up, strategy number 3, investing through self-managed super fund. Now, this one is a bit more advanced, but it can be incredibly powerful. Self-managed super fund is basically a superannuation fund that you manage yourself and it can be used to buy property. The big advantage here is that properties held in self-managed super fund are taxed just at 15%, and if you sell the property during your pension phase, you could pay 0 capital gain tax. But, and this is a big but, self-managed super fund comes with strict rules and regulations as well. You'll need to work with a financial advisor or tax professional to set this properly. It's not for everyone, but if you are serious about building your long-term wealth, it can be worth looking into it. All right, let's move on to strategy number 4, the 50% capital gain discount. This one is pretty straightforward but super effective. If you hold on to property for more than 12 months before selling it, you only pay tax on half of the capital gain. Let me say that again, you only pay the tax on half. I'll give you a very small example. If you make 100K profit from selling a property, you only pay capital gain on 50,000. That is a huge saving. The key takeaway here is to think long term. If you can hold on to your property for at least 12 months, you will qualify for this discount and save thousands on capital gain taxes. Finally, let's talk about strategy number 5, offsetting gains with losses. This is a great way to reduce your capital gain tax bill if you had any other investments that did not go very well. Here is how it works. If you have sold shares or another property at losses, you can use that losses to offset the capital gain from selling your investment property. I'll give you a very small example and you will be able to understand this. If you made 50K profit from selling a property but lost $20,000 on shares or crypto, you will pay only CGT on 30,000. The trick here is to keep track of all your investment gains and losses throughout the year. That's the only way when tax time rolls around, you can use this strategy to take advantage of it. So let's recap it again. Number 1, use the principal place of residence exemption. Second is take advantage of your 6-year rule. Number 3, consider investing through a self-managed super fund. Number 4, hold on to your property for more than 12 months to get the capital gain discount, which is 50%. Last but not least, offset your gains with losses from another investments. Now, I want to hear from you. Which of these strategies are you going to try? Or do you have another tip to share? Let me know in the comments below. If you found this video helpful, don't forget to give it a thumbs up, subscribe to the channel, and hit that notification bell so you don't miss out more tax tips. Thanks for watching. I'll see you in the next video. Thank you.